Welcome back. You're watching Your World at 10. Now, last year, deal-making was all about big government rescuing failing financial firms. But this year, M&A activity has picked up, and how? To name just a few mega deals, Pfizer bought Wyeth, a lot more happened in pharma, Oracle bought Sun, Dell recently bought Pero Systems, and Kraft is pursuing Cadbury. To get a ringside view of all the M&A action expected by the end of this year and next, I'm joined tonight by John Studzinski. He needs no introduction for those of you who are in M&A, but for outsiders, John has worked with Morgan Stanley, HSBC, and is now Blackstone's Senior Managing Director and Global Head of the Corporate and Mergers and Acquisitions Advisory Group at Blackstone, a group that's been involved in many recent high-profile deals, including CDB, that's China Development Bank stake purchase in Barclays, Microsoft's interest in Yahoo, that's a big deal, hasn't happened as yet, but a big deal, and the financial restructuring at AIG, which is ongoing. Well, John, thank you very much for joining us on Your World at 10. I understand that you're in India very frequently, once in 6 to 8 weeks, you tell me. Are you currently consulting with any large Indian corporate houses on big M&A deals? What are you talking to them about? What's it looking like?
The Indians are at the table, and they are involved in the sort of the global discussion, flows of capital, and many of them are looking at projects right now. We do have some mandates in areas such as infrastructure. We also are working with a number of clients as they look abroad for certain types of investments.
When you say infrastructure, you're referring to infrastructure consolidation, M&A, or are you doing other kinds of corporate advisory work for them?
Well, I think you raise a good point. Let's get to this term M&A, because I think it's a term that was created in the late 70s, and I think what's happened in the last really 2 years is the notion of an M&A product is now being replaced by the notion of a sort of corporate finance solution. So you have a lot of companies that have been more skeptical about buying businesses because many boards wonder, do you really need to do M&A to have a strategy? You have other companies that are needing to sell businesses to pay down debt. You have people that are restructuring debt. And you have also people who say, we need more equity capital. So you're dealing in an environment now where we're going back to basic corporate finance 101.
So are you a consultant then? Because I don't know, this seems like somewhere the grey area between the pure M&A boutique advisory firms and the large consulting firms that tend to do often the same things that you do, right? Look at business process, look at the organization, tell companies whether they need to raise money or they need to look at consolidation or M&A, or where do you fit in all of this?
I think we are consultants, corporate doctors, listeners to chief executives and boards as to what they need to do, either to accomplish their objectives or to solve problems. I love to ask a chief executive, tell me what worries you most. And it's been a fascinating question, particularly in the last 12 months.
So what worries them the most?
Many people, until about a year ago, never understood counterparty risk. So you'd have a tech company that was supplying components to another tech company, didn't realize that that tech company actually had financial frailty in their balance sheet and wasn't able necessarily to make payments. So, for example, many chief executives really a year ago started to understand liquidity. And it wasn't just the financial sector. It was certain parts of automotive components. You saw that in the United States with some of the parts providers of General Motors and Ford. You also see in the tech sector. So I've seen a lot of chief executives learn a lot more about corporate finance 101, cash management, liquidity, and capital structure in the last year than they've ever learned before.
How are you going to get a foot in the door in India, with large corporate houses? Because this is a business that runs on relationships and personalities, and traditionally there are certain investment banking outfits in India that have always had access to some of the large corporate houses, and in the last few years they themselves feel a little restricted or compromised because you've had all the foreign banks come in with large pockets who are not just offering advisory services, but also the ability to finance deals, put $5-8 billion on the table overnight, and that has tended to edge out some of the smaller investment banks, domestically homegrown investment banks, who are now hoping that after the crash of the last 2 years, companies will not just want to look at a financing ability when they look at someone who offers them advice. So how do you hope to get a foot in the door with the Indian M&A business?
Well, I've been coming to India for 25 years. I came to India when I was at Morgan Stanley. I came here a lot when I was at HSBC. I have a lot of time for Naina Kidway. She's a good friend, and she has a fabulous network and is well respected as a banker here in India. But remember, Blackstone's advisory practice is not about league tables. It's not about being all things to all people. People hire us because they want grown-up advice by people that have had 20 or 30 years in the business.
Right.
Well, grown-ups actually now want to be advised by grown-ups. They're tired of being advised by armies of just bright, young bankers. They want people that have had experience, and they also want people that really understand boards and stakeholders. I know a lot of the key people in India. We've been working with them on a number of projects over the last 10 years, and they are actually part of a global network. They're as fluent in New York or London or in Hong Kong as they are here. And we have to keep reminding everybody, Indian companies have been cosmopolitan for a long time.
Mm-hmm. But the fact that you don't bring any financing on the table, does that, sort of restrict your ability to get more clients on board? That's one question. Secondly, at any point, does the private equity arm of Blackstone or that function of Blackstone merge in with this arm? So if you're consulting a company on a deal that they potentially want to do, and maybe they're looking at partners and being able to pull that consolidation off, would you come in and want to buy stakes? I mean, does that all blend and mix?
Excellent questions. The fact we don't provide financing is a plus. People see us as independent, and they see us as not conflicted because we don't have an incentive to sell a financial underwriting or a financial product. The private equity aspect of your question is even more interesting because Anglo-American cultures are quite wary that if you're advising me, I don't want you investing alongside. But as soon as you fly across Europe, across the Mideast, across the subcontinent, through India and Asia, what you find is you say, okay, if you're investing with me, I'll take your advice. If you're advising me, well, why don't you put your money on the table? So there's much greater synergy. Many clients actually like the fact that Blackstone has an investor-oriented sort of culture. Many clients say, okay, what's the return on this deal? If we're looking at this project, what would your return criteria be, Blackstone? And we want that factored into the advice. One of the reasons why the Chinese government works a lot with us, and a lot of family businesses work with us, is because they actually are very return driven, and they want us to apply the same sort of hard rules of return to their same types of projects. So that's actually a plus. And sometimes, I talked earlier about how people need new sources of capital. There are times when Akhil Gupta and I will talk only after the client has requested it and say, does it make sense for Blackstone private equity or other private equity firms? Because private equity is a very bespoke area. No two private equity firms are interested in investing in the same thing. So if I'm advising a client, I'd say, okay, let's talk to Blackstone, but maybe we should talk to one or two others as well.
Okay, you spoke of China. India, China, do you think? Or because this has been an interesting year. Last year we saw, I'm not even sure if you'd call it deal making, but it was so much of government stepping into the American or the British or the European financial sector and helping it stand up. This year we've seen from the beginning of the year some pharmaceutical deals. We've seen, I think the comeback of M&A in some sense. Do you expect, or what is your assessment of what the environment currently is for deal making? And do you expect India and China will be the centers of all of that activity over the course of the next 4 or 5 years? Disproportionately. I know they're important economies, but disproportionately.
Well, the big activity in India, as you know, at the moment, the last 2 or 3 years domestically, has been energy, telco, and financial services. Internationally, people have invested principally in metals mining and industrials. But going into India, people are still... inbound capital is very much focused still on telcos and healthcare. But as I look globally, where do we see big activity right now in terms of funds flows? Technology, healthcare, and telecommunications.
All right, so final question on M&A. Are the deal and you may have answered this in part in some of your previous responses, but are the deal dynamics in emerging markets like India very different? I mean, are companies, the way they finance deals or the way they look for ownership or the way they go about doing their transactions, are they any different from M&A elsewhere in the world? Actually,
no, they're in some respects much more fun because it's a bit like going to the theater. Everything is, every meeting is a little different. People have less experience. And people are more honest about they don't have experience. You have these well-run Anglo-American corporate entities where they've been doing M&A for 25 years. So it's a bit like a Swiss watch. You just push the button and the coffee's made, the milk is heated, the sugar is added, and you have the perfect cup of coffee or tea or whatever. In emerging markets, you've got many more stakeholders that are below the surface, below the radar screen. You've got a lot of nuances of government that people are not aware of. You have elements of corruption, which, terrible word, but it's a fact of life, and you have to go into these meetings and these situations with your eyes open, and you have to protect your client, protect the client shareholders. So these situations in emerging markets are much more, they take longer, there's many more surprises, they're never dull, and to a certain extent what happens is you're going to have to be more disciplined about what I call pencils down, which is you've got to put your pencil down and be prepared to walk away until you decide that things have cleared, or it's a little more clear, or you're a little more comfortable with the risks, and then you go back to the table. And people who are used to that just see it as part of the, whether you call it the kabuki, or playing the bridge hand or whatever, but it's part of the game.
John, thank you so much for your time. Thank you for speaking with us on CNBC TV 18.
Yeah, well, thank you for listening.
All right, that was John Studzinski of Blackstone. It's time for a quick break on Your World at 10. Coming up next.